Well, hello Dragons, and welcome to this instructional video for Lesson 9 Part 1, Gross Domestic Product. The main idea behind this economics lesson is the primary account used to measure a nation's output is gross domestic product. With that in mind, by the end of watching this video, you'll be able to determine how governments calculate gross domestic product, explain some of the limitations of gross domestic product, and identify other statistics economists use to measure the economy. Now that the outcomes for this lesson have been shared with you, let's get started. How do economists predict economic performance? Although predicting the future might seem like something done by a fortune teller at a carnival, economists do not rely on crystal balls or tea leaves for their information. Instead, they study the past and current performance of the economy as a whole. As noted in Lesson 1, the study of entire economies, as opposed to individual actors or markets within an economy, is called macroeconomics. Macroeconomists use measures called national income and product accounts, or NIPAs, to track production, income, and consumption in a nation's economy. This tracking process is known as national income accounting and provides information about a nation's economic activities. Total production, or output, is one measure of an economy's strength. The most widely used NIPA is gross domestic product, or GDP, the total dollar value of all final goods and services produced within a country during a calendar year. A closer look at three components of the definition of GDP will help you better understand what it says about a nation's economy. To avoid counting products more than once, economists include only the value of final goods and services when calculating GDP. How is a good identified as final? Suppose that a woodcutter cuts down a tree and sells it to a sawmill operator. The sawmill then processes the tree into lumber, which is sold to a furniture manufacturer. The furniture manufacturer in turn uses the lumber to build a dining table, which is purchased by a consumer. Of these items, only the dining table is considered the final product. The tree and the lumber are considered intermediate products, goods and services used to make other products. The value of the tree and the lumber are figured into the value of the dining table. To avoid counting these intermediate products twice, GDP includes only the value of the dining table. GDP also does not include products such as used cars and second-hand clothing. Because GDP is a gauge of production, not sales for the current year, sales of second-hand items are not counted. These goods were counted in the year they were produced. You should note that GDP measures only output produced within a nation's borders, regardless of who produces it. For example, the Coca-Cola Company owns several production plants in Russia. When economists calculate U.S. GDP, however, they do not include these plants' output because the production occurs outside U.S. borders. U.S. GDP does include, however, the output of foreign workers and firms within the United States. For example, the automobiles that are produced at a Japanese-owned Nissan factory in Tennessee. How is GDP determined? Four sectors of the product market combine to make up GDP: personal consumption expenditures, gross investment, government purchases of goods and services, and net exports of goods and services, or exports minus imports. To actually compute GDP, economists add the output produced by these four sectors by using the output expenditure model. This process is represented by the formula C plus I plus G plus the quantity X minus M equals GDP. The first element of GDP is personal consumption expenditures, or consumer purchases. Personal consumption expenditures include durable goods, non-durable goods, and services. Durable goods are items that have a useful lifetime of more than a year, such as automobiles and computers. Non-durable goods are items that have a short useful lifetime, such as food and cosmetics. Services, such as medical care, entertainment, and public education, are the fastest growing area of consumer expenditures. Real investment is the use of money to produce new capital goods. The results of this real investment, the capital goods produced, are measured as gross investment, which is the second part of GDP. Gross investment is the total value of all capital goods produced in a given nation during 1 year, as well as changes in the dollar value of business inventories. Economists divide gross investment into two subcategories: fixed investment and inventory investment. Fixed investment includes spending on residential structures, non-residential structures such as office space and factories, and capital goods such as new machinery and office equipment. Inventory investment refers to the increase or decrease in the total dollar value of the stock of raw materials, intermediate goods, and final goods of domestic businesses during a given time period. Note that gross investment does not include the purchase of financial assets, such as stocks, bonds, and land, because these purchases do not result in the production of any new goods or services. The third component of GDP consists of the total dollar value that federal, state, and local governments spend on goods and services, such as highways, public education, and national defense. Government transfer payments, expenditures for which the government receives no goods or services in exchange, are not included when calculating government purchases. Transfer payments include Social Security payments and various types of government aid. The final component of GDP is net exports, total U.S. exports minus total U.S. imports. As you have learned, GDP measures goods and services produced within a given nation's borders. Thus, GDP includes the value of goods and services produced domestically, but sold in other countries, or exports, and does not include goods and services produced in other countries, but purchased locally, imports. Some goods and services included in GDP, however, are actually produced in other countries. Likewise, some items produced in the United States are sold in other countries and fail to get included in the other components of GDP. To account for this movement of goods and services in and out of countries, economists subtract total imports from total exports and add the result of the other GDP components to obtain total domestic output. In 2019, personal consumption expenditures equaled $13.28 trillion. Gross investment equaled $3.42 trillion. Government purchases of goods and services equaled $3.30 trillion. Exports equaled $2.53 trillion. And imports equaled $3.49 trillion. Placing these dollar amounts into the output expenditure model gives us a GDP of $19.04 trillion for 2019. Suppose that Rosa serves as treasurer for the math club at her high school. In preparation for the club's annual candy sale, Rosa reviews the sales figures for the last 2 years. Although the club raised almost twice as much money last year as the year before, Rosa notices that the price collected by the club for each candy bar increased from $1.25 to $2.50 from the first year to the next. However, the number of candy bars sold each year was approximately equal. The rise in price had masked the lack of increase in candy bar sales. In 2019, U.S. GDP was more than double than 1995, and nearly 9 times what it was in 1980. As in Rosa's case, however, these increases do not necessarily derive from real increases in the output of goods and services. As prices increase, so does GDP. Consequently, economists calculate GDP in both nominal and real prices. Nominal GDP, or current GDP, is GDP expressed in the current prices of the period being measured. Real GDP is GDP adjusted for price changes. Calculating real prices allows economists to determine if production increased or decreased, regardless of changes in the purchasing power of the US dollar. To measure changes in prices over time, economists use price indexes. A price index is a set of statistics that allows economists to compare prices over time. To create a price index, economists first select a base year against which to measure changes in prices. Second, they assign the base year to an index number of 100. Third, they calculate index numbers for other years to indicate the amount prices are higher or lower relative to the base year. Economists update the base year every few years. Although GDP is the most common measure of the state of a nation's economy, it is not an entirely accurate measure of output and economic growth. To properly interpret GDP and other national accounts based on it, one must understand its limitations. When computing GDP, economists use estimates and sampling techniques to determine prices and quantities of goods and services. Gathering the necessary data is a slow and time-consuming process. As a result, initial GDP figures are often inaccurate, and the Commerce Department may have to issue revised figures. Government and business decision-makers who use GDP and other NIPAs must either rely on initial figures that may change, or they must wait several months for more accurate figures to be calculated. Even then, decision-makers must keep in mind that GDP and other NIPAs are only approximations of total output and income. Suppose that every Saturday, Tim mows his parents' lawn. Routinely, he also makes his bed, cleans his room, and washes the car, all at no charge. Although these activities are productive, no financial exchange takes place. As a result, Tim's household chores are not included in GDP. For the most part, GDP measures only market transactions, exchanges of goods and services for money that are recorded in the marketplace. Transactions that do not involve money and are not recorded are non-market activities. Barter transactions, housework, and do-it-yourself home repairs are examples of non-market activities. If Tim decides to start charging his parents for the household chores he performs, measured GDP will increase. However, the amount of real output will not have changed. Thus, GDP does not measure all output, and changes in GDP do not necessarily equate to changes in real output. Suppose that Fran spends many of her afternoons working at her auto repair business. She works out of her garage, does not advertise, and accepts only cash for payment. In this way, Fran avoids reporting her income and paying taxes to the Internal Revenue Service. Fran is taking part in the underground economy, illegal activities and unreported legal activities. Although Fran's business is a legally accepted activity, her failure to report that activity and any income from it is illegal. Just as GDP is an imperfect indicator of economic growth in a nation, it is also an imperfect indicator of a nation's overall well-being. The value of many goods, things that make for a better society, are not reported in GDP, while the value of many bads, things that make society worse, are. Governments and economists must carefully analyze costs and trade-offs when considering policies designed to stimulate economic growth. Some policies that protect the environment or improve society result in decreased GDP. Nevertheless, the government sometimes decides the trade-off is worthwhile. Automotive emission standards and regulations that prohibit development in ecologically sensitive areas reduce GDP, but improve the nation's well-being. Some economists have proposed using a new measure for the economy that accounts for the goods and bads, and thus more accurately measures a nation's well-being. Positive dollar values would be assigned to goods, such as leisure time and urban renewal. Likewise, negative dollar values would be assigned to bads, such as pollution and traffic congestion. Besides GDP, economists use a number of other national income and product accounts to track and measure a nation's economy. The 5 most common accounts are gross national product, net national product, national income, personal income, and disposable personal income. Although all 5 measures are important in macroeconomics, economists most often use the measure of GDP. Until December of 1991, the Commerce Department used a NIPA called Gross National Product, or GNP, to measure the U.S. economy. GNP measures the total dollar value of all final output produced with factors of production owned by residents of a country during 1 year. Consider the Coca-Cola plants from the earlier example. The plants employ mostly local labor. The contribution that these Russian workers make to production would count as part of Russian GNP. If production involves any capital owned by U.S. residents, however, the value of that production would count as part of U.S. GNP. Although GDP and GNP are similar, GDP more accurately reflects short-term resource use changes in the economy. In addition, the United Nations and most countries use GDP as the primary measure of economic production. For this reason, the Commerce Department switched to GDP and stopped using GNP in December of 1991. The change has made it easier for U.S. economists and business firms to make international economic comparisons. As you have learned, GDP includes money invested in capital goods. This investment includes money spent on replacing defective or outdated equipment and machinery. When this depreciation is subtracted from GNP, the result is a nation's net national product. Because net national product does not include investment spent to maintain current equipment, it is a more representative measure than GNP of a nation's actual output of new goods and services during a given year. Nevertheless, even though net national product is a better measure of a nation's output, economists use it less frequently than they use GNP. Net national product usually accounts for about 90% of GNP. To determine the total income paid to the owners of a nation's factors of production, economists use the measure national income. National income refers to the sum of employees' and proprietors' income, real and estimated rental income, corporate profits, and net interest. To calculate national income, economists subtract subsidies and indirect taxes from net national product. Indirect taxes, as opposed to direct taxes on income, are taxes included in the final price of goods and services. Sometimes economists are interested in the total amount of incomes earned by people in a given nation. To estimate this measure, economists subtract from national income all income that does not go to people, such as profits that firms retain and reinvest, and money that firms spend on corporate income taxes and employees' Social Security. Economists then add to this amount the money that individuals receive from government transfer payments, such as Social Security checks. The result is personal income, the total amount of income paid to individuals living in a given nation. If you have ever received a paycheck, you are familiar with the difference between your gross pay and your net pay, or the amount of money that you actually take home. Your take-home pay shrinks noticeably once deductions are made for government programs, such as Social Security and income tax. Thus, only a portion of personal income is available to consumers. To estimate a given nation's disposable personal income, the total amount of income available to a nation's people to spend or save, economists subtract personal taxes and non-tax payment from personal income. Personal taxes include income, estate, gift, property, and motor vehicle taxes. Non-tax payments include fines and passport fees. So that's the way it is with Lesson 9, Part 1, Gross Domestic Product. At this time, you should know that Gross Domestic Product, or GDP, is the total dollar value of all final goods and services produced within a given country's borders during 1 year. Economists use the output expenditure model to calculate GDP. Economists calculate nominal GDP and real GDP to compare increases or decreases in prices from year to year, and GDP has limitations and is not the only measure of national income in product accounts, or NIPAs. Don't forget to subscribe to my channel and have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons!